Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Welcome to a special edition of the Opto Sessions podcast. I'm Hayden Brain, and along with my co-host Ed Gotham, we've identified our favourite episodes from what's been an unprecedented year for global stock markets. We've narrowed it down to a top 8, selecting 4 clips each from our favourite interviews this year. Featured guests include investing royalty Jim Rogers, who alongside George Soros co-founded the Quantum Fund, and Jack Schwager, the international best-selling author responsible for the Market Wizard series. We really enjoyed taking stock and looking back at some fascinating interviews, and we hope you do too. In episode 33, I spoke to Morgan Housel, award-winning author of The Psychology of Money, Timeless Lessons on Wealth, Greed and Happiness. Traditionally, books about investing and finance more generally are rooted in mathematics. However, Morgan's book, the collection of 19 short stories, explains how behavioural traits, the way a person thinks about money, always outweigh that individual's analytical skill. Housel substantiates his assertions by telling the stories of investing and business greats, including Warren Buffett, Bill Gates, Jesse Livermore, as well as many you've probably never heard of. Cavalry Media, responsible for box office hits including Captain Phillips and The Social Network, were so taken with the Housel stories, they optioned the rights to bring The Psychology of Money to the big screen earlier this year. We pick up the interview as Morgan explains his investing philosophy through the lens of the 2007-8 financial crisis.
My writing career really began in 2008. That's when I started as a full-time writer. And today, of course, was the great financial crisis when the global economy nearly collapsed, the financial system nearly collapsed. So a lot of my early years as a writer were devoted to answering the question, why did this happen? Why did the financial crisis happen in the way that it did? Why did people make the decisions that they did? Why, have we learned anything? Those are the questions I was trying to answer. And I realized that the answer to those questions could not be found in an economics textbook. There was nothing in an economics textbook that could have explained why people made the decisions that they did leading up to and during the financial crisis. But I realized over time, and again, it was a slow realization, but I realized the answer to some of those questions could be found in a psychology textbook and a sociology textbook and a history textbook and a political science textbook, those kind of things. And I'm using the word textbook there, but just in terms of, just viewing the world through a lens of those fields, you could start to explain why people made the decisions that they did. So that was a realization to me that, what really matters in investing and in finance is not what you know. It's not about how smart you are, the analytical skills that you have. And it's not that analytical skills don't matter, but what is really important is that if you have analytical skills, but you do not have behavioral skills, the lack of behavioral skills can neutralize any of the analytical skills you have. Because think going into the financial crisis, you could be the smartest financier in the world. You could have all the analytical intelligence, a PhD in finance from Harvard. But if you panicked in 2008, if you panicked in March of 2020 this year, or if you panicked in 2000, none of the analytical skills mattered. Like you have to have the behavioral part down before the analytical side means anything.
Hi everyone, Ed Gotham here. In episode 16, I asked JC about how to anticipate market reversals. In an ideal world, of course, everyone would love to time market reversals so they can sell at the top and buy at the bottom. But in reality, this is exceptionally hard to do, even for the professionals. But JC gives us a great outline here about how he approaches this, which I believe has an incredible amount of merit. This is why it's included in my top takeaways from Opto Sessions this year. So in particular, he concentrates on market breadth. So are we seeing a general decline across sectors and stocks, or is it just weakness in some areas? Sector rotation is something that's seen as a positive. So this is something to definitely differentiate from market breadth. We've seen sector rotation relatively recently in the energy sector, for example, which has given growth stocks a breather, which have done exceptionally well for the year. Energy has been an outperformer in recent months, which is seen as a positive market sector rotation, with capital being sort of pushed into other areas, bringing those areas that weren't doing so well up to the sort of reverting to the mean, if you like. Whereas in market breadth, you might see a general decline across all sectors, And this early indicator of this happening with lower lows should be a warning sign, basically. Also important here is that JC didn't know there was going to be a crash. He can't predict the future, but he just knew there was indications of further weakness and therefore readjusted his portfolio accordingly. So here's JC's response after I asked him about market reversals with particular reference to the crash earlier on this year.
We were the biggest bulls on Wall Street in the fourth quarter last year. Buy everything, buy breakouts, all of that. And then I would get asked, they're like, well, JC, what is it going to take for you to be bearish? Because a lot of people were surprised at just how bullish I was from last summer. And I'm like, well, we need to see deterioration in market breadth. We need to see fewer stocks making new highs, fewer indexes making new highs. We're seeing the opposite. We keep seeing more and more and more, right? So that's what we're seeing in the fourth quarter last year.
Yeah.
And coming to January this year, regional banks had already peaked in December. So the amount of stocks making new 52-week highs peaked on January the 16th, actually. So we were seeing fewer and fewer sectors making new highs, fewer and fewer stocks showing bullish momentum characteristics, just breadth deterioration after breadth deterioration again and again and again. So by the time early February came around, we were shorting everything in sight, sell everything, buy bonds. It was really a breadth deterioration scenario where we knew we did not want to own stocks. In fact, we were shorting them very aggressively in February, well before any crash. Not that I knew there was going to be a crash. I just knew we didn't want to own stocks. Whether stocks went sideways, down a little, or down a lot, I didn't know. But in any of those scenarios, we didn't want to own stocks. So it was less about what's going to happen and more about whatever happens, happens. We don't want to be involved sort of scenario. But I've said it before and I'll say it again. This stock market crash came after more warning signs than any stock market crash in world history. In February, the S&P made new highs, the Dow made new highs, and the NASDAQ made new highs. The Russell 2000 did not. Mid-caps did not. Micro-caps did not. The Value Line Index did not. The Dow Jones Transportation Average continued to diverge negatively. Classic Dow theory sell signal. Breadth deterioration. The list of 21-day highs deteriorating. The list of 63-day highs deteriorating. The list of 52-week highs deteriorating. The list of stocks showing bullish momentum characteristics deteriorating. An expansion in new lows. Regional banks made new all-time lows relative to the S&P 500 before the market peaked. Like, I mean, I could go on and on and on, but it was quite obvious.
Chris Camillo is the founder of Dumb Money and an investor that's turned $20,000 into over $30 million and counting. Dumb Money is a YouTube channel with over 65,000 subscribers on which Chris and his two co-founders, Dave Hansen and Jordan McLean, chronicle the investment of their own money, having quit the day job to pursue investing full-time. Chris has pioneered a unique investment strategy that he calls social arbitrage, based on the premise that if you can identify an information imbalance where popular sentiment is yet to be reflected in a company's market value, then it's time to buy. I talked to Chris about one such example, a favourite trade of his betting on the trend in DIY slime.
This is an example I love, actually. It's one of my favorite trades. A few years ago, there was a trend that was happening. It was happening globally with kids. And kids all out of nowhere started to make slime. And what I mean by slime is actual slime, right? So it became a big crafting trend for kids and moms to do with kids, to where they would create all kinds of different colored slime and different textured slime just to kind of play with at home. And it's something that I picked up on really early on. And that was just simply a change in behavior, in what kids like to do. And the trend lasted for over a year. It just happens to be that one of the primary ingredients for DIY slime, right? Do-it-yourself slime is white glue. And the world's largest manufacturer of white glue is Elmer's glue. I was able to surface that trend very early, and I connected the dots to Elmer's glue. And then when I started researching Elmer's glue, I realized that they were selling out, right, globally. So it became next to impossible to buy Elmer's Glue. Well, Elmer's Glue is a subsidiary of Newell Brands, which is a publicly traded company, maybe better known, they used to be called Rubbermaid. Although Elmer's Glue is a really small part of that company, the company itself is a slow growth company. So even if Elmer's Glue was only 1 or 2%, and I think they were like 1 or 2% of the total company in terms of revenue, their revenue increasing by 50%, which is exactly what happened at Elmer's Glue, was able to have an outsized impact on the overall company and really move the needle for earnings for multiple quarters in a row. And what was amazing is that Newell Brand stock price, I think, went up 17 or 18% over the course of a couple quarters. It was a trade that I had, initiated. It was a levered trade. And I think I ended up making, I don't know, maybe close to 200% on my investment over a very short period of time. But that's a really interesting example where the whole world could have seen this, right? There were tens of millions, if not hundreds of millions of families globally where there were kids making this slime. How many were able to, make the connection between that and an ingredient of slime and the company that was investable based on that trend?
In episode 18, I had the delight of speaking to Joe Clement, who is the author of 7 Mistakes Every Investor Makes and How to Avoid Them. This one is solely focused on human psychology, and that looking at your portfolio too often can cause you to make bad decisions. It's really interesting how he uses some analysis of historic market behaviour to show that even though most of the time indices trend up, on a daily basis they are up only half of the time and obviously down the other half. Looking at your trades or portfolio too often can cause you to make decisions outside of your strategy, overtrade, and a lot more things. It's all part of the challenge of overcoming yourself, which in reality is what successful trading or investing is all about. Overcoming your own mental weaknesses. So here's Joe's response after I asked him to reveal one of the 7 mistakes from his recent book.
We tend to look at our portfolios at the moment too often. To give you an idea, if I have a stock portfolio, and if I look at that portfolio, say once a year, well, we know that in 3 out of 4 years, stock markets are up. So for in 3 out of 4 years, I will see a positive return on my stock portfolio. Now, if I look at the same stock portfolio on a quarterly basis, I see a little bit more the swings that happen during the year. If I look at it on a monthly basis, I see even more of those swings. And if I look at it on a daily basis, the interesting thing is that half the days are negative in stock markets and half the days are positive. Now, the thing is that if I look at it on a daily basis, the positives are a little bit better than the negatives. That's why in the end, over a full year, stock markets tended to be up. But if I look at it more and more often, then what happens is I see those fluctuations and I become more scared. And that is exactly what a lot of people have done again during this crisis. If you go back to February, March, April, what happened is the market started really well into the year. It was up slightly. And then the COVID crisis hit. And in March, literally every day we went down 10%, 10%, 5%, 10%. And so it was a real onslaught. And of course, we all get worried in these situations. I am no different than anybody else. And the temptation is, I want to take a look at my portfolio and see what it's done. And obviously, if you do that and you see it's down 10%, 20%, 25%, your temptation is, I have to sell something. I have to sell either everything or I have to sell the biggest losers or some of the stocks. I have to do something to make this stop. And then what happens is that you typically sell at a really bad time. Simply because you looked at your portfolio constantly. Maybe you didn't sell the first time you looked, but maybe you looked a week later and you saw it even go down even more. And then at some point you sell it and you typically reduce risk in these circumstances. And then what happens is we missed out, or the people who did that missed out on the recovery that we've seen since April. And as a result, they've compounded their losses by just basically looking at it too often, which triggered a short-term reaction, triggered too much short-termism in our actions as investors, and cost us dearly over the subsequent months. And I think that is something that I've been guilty of in the past myself, and that I see a lot of people doing in this crisis again.
Back at the start of May, I spoke to Jim Rogers, investment legend and co-founder of the Quantum Fund, which famously returned 4,200% over just 10 years. Since those heady days, Jim has travelled the world twice, and he took me on a whistle-stop world tour of the best value investments and which markets to find them in during our interview. Jim explains that although he wouldn't categorise himself as a contrarian, he does look for downtrodden, ignored assets that are, in his opinion, unjustly disfavoured by the wider market. Amongst other fascinating picks, Jim highlighted Venezuela as a market worth watching over the next couple of years, even if he's unable to actually invest there himself.
Well, given that what I usually invest in is something that is ignored and is cheap and is struggling, that by the definition of contrarian makes me a contrarian. I would not say that, though. I would say, I just try to find things that are cheap, that where something is changing. But by definition, Hayden, if it's cheap, that means people are ignoring it for whatever reason, and it's down for whatever reason. And so people say, he's a contrarian. He's buying that cheap bankrupt company. I'm buying the cheap bankrupt company because I think I see it's going to be a good investment. Not sitting around saying I'm going to be a contrarian. I'm looking for opportunities. And often I have found over the decades that if you find things that have collapsed, you're often going to make a lot of, Venezuela is a perfect example right now. I cannot buy anything in Venezuela because I'm a citizen of the land of the free. And in the land of the free, we're not so free often. But other people can buy Venezuela. It's been my experience that you buy a disaster or catastrophe, usually in a few years, you're going to make a lot of money. I'm not allowed to right now because I'm a citizen of the land of the free.
Moving on now to Jack Schwager, obviously the author of the Market Wizards series. And we discuss a lot of things in the podcast, but we also go into detail on some investing misconceptions. And one of them stood out in particular, which was about an overemphasis on recent returns. I'll let Jack dive into more detail on this, but it's based on the concept that sectors revert to the mean over time, and therefore things that outperform will eventually underperform at some point and vice versa. This is something you can apply on a macro level too, and you should be asking yourself questions, for example, about whether the US stock market will continue to outperform as it has done for the last 10 years after its recent bull market, or will it underperform against developed nations and emerging markets which are in early stages of breaking out from their long-term sideways trend. But here's Jack to tell you more.
Let's take one that just about all investors fall prey to, which is overemphasis on more recent returns. And so if you take it from, I'll take it from two standpoints, one from index funds or just general investing in the stock market, let's say, and another would be, let's say, on hedge fund performance. It's the same principle, but they're different points. So, most people, if you look at where inflows go, they usually are biggest after you've had a long bull run in the markets. And if you look at what happens 10 years, 15 years, 20 years forward, and I've done the analysis, the worst performing periods come, not surprisingly, after you've had really good performance. And the best performance horizons are when the market's done really terrible. So if you invest when the market has done really lousy for the last 5 years, the last 10 years relative to history, and I've took these numbers all the way back to the 1850s, you do best by investing for the longer term when the market has done really badly in recent years, which is the opposite of what most people do. And when you take it something like hedge funds, the interesting thing, I did a study, is not particular hedge funds, but sectors. It's like about 30 plus sectors based on HFRI. So I did a study where you took the best hedge funds of the last performance, the best sector of the last 3 or 5 years, or best 1, 3, and 5 years, and the worst 1 and 3 and 5 years performing sector. And if you looked at what happened over the future horizon, like when you invest in one of those, you found that on a return risk basis, you actually did better investing in the worst performing sector of recent years. averaging those to 1, 3, and 5 than if you invested in the best one. And that sounds counterintuitive, but the explanation is easy, is because the sectors that have outperformed are the ones that had a wide, it's part of reversion to the mean. They've had a wide move away from some historical norm. That's why they've outperformed. So let's say oil or something like that. If oil has a real big run, has done really, really well, oil sector, or energy sector, I should say, will be one of the top performers. Vice versa, if it's done really, really poorly. So what you end up when you're picking a particular hedge fund, you're picking one that is focused on a certain sector. The ones that perform best a lot of times are those who just happen to be in the right sector. And that's true also on stock sectors, by the way. It's not just hedge funds. So again, it's kind of counterintuitive that if you pick the best performing ones, you actually end up doing worse than average. And sometimes worse than picking the worst performing one. So that's one big misconception area.
Fahmi Kadir is the founder of New York hedge fund Safket Capital and shot to fame through her now legendary short of Valiant Pharmaceuticals, a bet that brought a $90 billion company to its knees, and which has since been documented in the critically acclaimed Netflix series Dirty Money. I spoke to Fahmi in June, at which time she was leading the campaign against Wirecard, a now insolvent payments company currently being dismantled after criminal charges were brought against the company's leadership team, with the firm owing over €3 billion in debt. 5 years on from the Valiant short, Fahmi talked through the events preceding the company's fall and what it took to go up against this industry heavyweight, as well as investment titans, including Bill Ackman.
I'm not sure if it's fair to say that only a handful of people recognize the issues at Valiant. I think there were definitely a group of smart investors who were talking about how Valiant was engaged in financial engineering and earnings smoothing, and how it was essentially this house of cards. I think that narrative was there for a while, but the issue was with Valiant is that you had a successful, sophisticated group of institutional investors who were long and successfully long Valiant for a very long time. Individuals who otherwise would not get involved in investing in going long fraudulent companies. So I think that disconnect perhaps scared others or deterred them from going short. But I came to this story as a complete outsider, so I didn't really understand or care for the dynamics then or now. I don't really think about Bill Ackman. For me, it was more about understanding the business model and the sustainability of that. It's one thing to understand that something is wrong and that there may be, smoke and mirrors involved, but it's another to actually go short. And I think because of the dynamics at play here, people were definitely afraid to go short. The stratospheric rise that the stock had over the years preceding 2015 also definitely deterred people. So even as the short thesis started to materialize on Valiant, I think people were apprehensive of staying short. So I believe throughout that whole, 1-2 year period, my firm was short. Maybe as a small fund, we were short, at some points over 10% of the short interest. So while it was lonely actually shorting, I think there was definitely a lot of skepticism. But for me, it came down to understanding how long can the game go on. And the thing about the pharmaceutical industry is that it is very established. There are a certain set of norms, there's a certain set of regulations, and a certain set of behaviors that lead to success. And when a business comes in and starts to actually throw some of these norms to the wind, then it's a cause for concern. So it really was as simple as understanding that, yes, Valiant was an acquisitive roll-up, and it benefited from a tax inversion scheme. At the end of the day, because it was raising the prices on all of these drugs to a level that they were completely unaffordable, to the point where insurance companies were starting to slow down the reimbursement of the drugs. What that means is that you won't have patients to actually take those drugs. So ultimately, this can't keep going, especially if you're unable to continue with inorganic growth, which would mean acquiring more businesses. So when I came to the story 5 years ago, they had completed their acquisition of Salix Pharmaceuticals, and they were sitting on a pile of debt. And that's really when things started to unwind. And where they were with their product portfolio, the sales had really peaked. So the unwind seemed clear to me when I came in.
And here's the final takeaway in this episode, and it's from the respected trader Brian Shannon. We talk about his motto, only price pays. Brian believes most technical analysis is largely a distraction, and the true value of technical analysis in practice is simply for trend recognition and risk management. He believes there's only one thing that pays us or punishes us in the market, and that is price action. This is a theory backed up by many of the other traders and investors we've had on the show, such as 50 Pips and JC. And here's Brian on his trademarked phrase, only price pays.
Sure. I started realizing that the market doesn't care about my opinion. I used to read, devour all kinds of value line, which was a thing back in the day. I don't know if they still have that, and just read research reports and even annual reports. And I would feel like I really knew a company well, and I would go to buy it and the stock would go down. And I started thinking, well, all this research, all this wasted time, and here I am, losing money on this, and I thought I knew it so well, and I would, make the classic mistakes of averaging down. The market's wrong. How could the market get this wrong like this? And I started reading headlines, and it started occurring to me that, one of the first things, when I was 18 or 19 years old, I read something about a company who was laying people off. And then the stock went up. And I was thinking about it saying, well, I intuitively at that point, I thought, well, that doesn't make sense. Their business is weakening. The stock should go down. And then I realized, I dug into it. Well, wait a minute, this is good for their business because they're cutting costs and that sort of thing. That it's not the headline that matters, but it's the reaction to it. And we have egos and we place a high value on what we think the market should do. But if we get stuck in that mindset, and the stock starts going against us, it's going to be very frustrating, and we're going to be losing money and arguing with the logic of it the whole way down, just like we have right now. This market is up 30+% off the COVID lows, and we're seeing record unemployment. We're seeing businesses still shuttered and things that just seem so bad for the economy. But if you just listen to price action, you would have moved out of any short positions on the way down, as it started rallying, and then start to look at recovering stocks and saying, well, maybe I don't trust them, so I'm going to trade smaller share size. But price is moving higher. I don't want to argue with price action because I know who loses in that battle. It's going to be me, not price.
Well, that's it, everyone. Thank you for tuning in. We hope you've enjoyed the episodes this year, and we're looking forward to bringing you more insight from the world's best traders and investors in 2021. Ciao.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends. And in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.